please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
A very good morning. Welcome to Power Breakfast. We are on the Mumbai News Centre. I'm Nigel D'Souza, and with me is Ekta Batra. Hi Ekta, good morning. We thought we'll have good news coming in from the United States. Unfortunately, I think the tax bill has been sent back, so there'll be some renegotiation over there. And that's why I think the US markets, after the run they've had, there's some kind of profit booking.
Yes, absolutely, Nigel. Well, there is some amount of profit booking, and we can see that the SGX is also a bit tepid in terms of a start at this point in time. So maybe that all-time high could be a little more elusive as opposed to just taking it out this morning. But any which way, more on that in just a bit. These are top stories. Wall Street snaps two-day winning streak. President Trump's contentious tax bill hits a snag as Republicans have been forced to send the bill back for revision after it appeared to violate Senate rules. Asia's mixed.
And Tata Steel announces its biggest expansion plan in 4 years, set to pump in 23,000 crore rupees to add capacity at its Kalinganagar plant in Odisha.
India's largest mortgage lender, HDFC, unveils a 13,000 crore fundraising plan, funds to be used to explore opportunities in the health insurance space and newer segments as well.
And Ruchi Soya becomes the first company to be sent to the bankruptcy court from RBI's second defaulters list. Insolvency resolution process initiated against the firm.
Market regulators SEBI may take a second jab at forcing defaulting listed companies to make faster disclosures, but the rules may get watered down. The plan, which was shelved in October, is part of the agenda for the market regulators board meeting next week. That's a CNBC Avaz exclusive.
Well, Asian markets, they're mixed in early trade as investors keep an eye on the US tax plan progress. So for starters, more or less flattish. We have the Nikkei, in fact, that's as flat as can be. You pull up the Kospi, that was holding with a gain of around 0.2% the last time I checked. So let's see what that one is doing. In fact, it's still holding with some green. And the Taiwanese index, I think the first tick was in the green, while the Straits was more or less flattish. Taiwanese index still holding with a gain of around 0.2%. Well, overnight we had the US markets that did see some selling from the top. The SGX Nifty is indicating, after the good run that we have had in the last few trading sessions, maybe a 20 to 25 point downtick is what we could see.
Okay, well, let's apprise you of what took place on Wall Street. US equities snapped a two-day winning streak yesterday. Decline in Apple shares from the tech sector dragged the market lower. The Dow Jones closed 37 points lower. S&P 500 declined 0.3%, while the Nasdaq also slipped 0.4%. Meanwhile, House Republicans passed the tax bill but have been forced to send the bill back for revision after it appeared to violate Senate rules. CNBC's Hampton Pearson gets us the latest on it.
Markets had closed when we got word of that snafu as far as the House vote on the tax bill that will require a revote in the House tomorrow. What looked like a victory for the House GOP, however, was not enough to offset losses in technology stocks that really pulled the major Wall Street indexes away from all-time highs. Away from the flip side, we had energy companies slightly higher due to rising oil prices. Benchmark U.S. crude up, for example, 33 cents, 57.55 a barrel. The close in New York, while Brent crude added 42 cents, 63.33 a close per barrel in London. Stocks weren't doing much on Tuesday. Bond prices fell. The yield on the 10-year Treasury note rose to 2.46%, its highest in almost 2 months. The Tuesday close was 2.45%, up from 2.39 late Monday. At the closing bell, stocks in the red. The Dow off by 37 points, the S&P down 8, the Nasdaq falling by 30 points. After-hour earnings leading the way, FedEx with beats on both the top and bottom lines. $3.18 earnings per share versus $2.88 the estimate. Revenue coming in $16.31 billion versus $15.68 billion was the estimate. FedEx says it's on track for a record holiday shipping season. It's up a little less than 2% after hours. Micron, a beat on both the top and bottom line. The revenue snapshot, $6.8 billion versus $6.43, the estimate there. Up on earnings per share as well, $2.45 a share versus $2.21. Micron reporting a surge in quarterly profit and revenue driven by higher demand in mobile, server, and data storage devices, so-called solid-state drives or SSDs. It is up more than 4% in after-hours trading.
Well, the Republican-controlled U.S. House of Representatives passed the landmark tax overhaul only to have hit a snag after 3 provisions in the bill were found to violate Senate rules. Republicans will have to vote on the GOP tax bill again later today. CNBC's Yellen Mui reports on the same.
The Republicans' victory lap here cut short as the House will need to vote again on the Republican tax bill. There were some problems with the bill in the Senate. The Senate parliamentarian ruled that several provisions in the bill did not comply with what are known as the Burr rules. I just spoke to House Ways and Means Committee Chairman Kevin Brady about this to get his response. He said it's no big deal. It's just a procedural process. They expected some challenges to be raised. But again, this does eat up the time that Republicans had been hoping to use to clear this off their plate and move over to a government funding bill. Also receiving a statement from Bernie Sanders and Ron Wyden, the ranking Democrats on the Budget and Finance committees. They said in the mad dash to provide tax breaks for their billionaire campaign contributors, our Republican colleagues forgot to comply with the rules of the Senate. So clearly this is going to be a Democratic talking point, at least for the next 24 hours, if not longer, as the House will have to vote again on the Republican tax plan.
Okay, well, staying with the U.S. and politics, House Speaker Paul Ryan is optimistic on the bill going through as per the anticipated timeline. Let's listen in.
On January 1, Americans are going to wake up with a new tax code. In February, they're going to see withholdings go down so they see bigger paychecks. And April 15th will be the last day they have to comply with the old bad system. This is a good day for America. This is a good day for workers. This is a great day for growth, and we're very excited about this moment.
Well, let's also listen in to what Jeremy Sagel, professor of Wharton School, makes of the tax plan overhaul as well as the impact on the markets.
I think we're only like 1% away from 25,000 on the Dow, and you know, that certainly can happen. But I'm one of those people, and I'm very positive on the tax plan. But it's sell on, buy on the anticipation, sell on the news. I think that all the good things about the corporate tax plan have been built into the rally that we have seen over the last 2 months, and I'm not sure how much else there is really going to be. The world of difference is the interest rate. Dot-com bubble, we had treasuries at 7%. Today they're 2.5%. Even if they move up to 3.25%, I mean, we're still in an amazingly low interest rate world. I think interest rates are, that's the world's largest asset class is fixed income. If they don't give competition, I think that's good for the stock market.
Okay, well, the Minneapolis Fed President Neil Kashkari, in an interest rate hike dissenter, says borrowing costs should not go up when inflation remains so low. He adds that raising interest rates only to constrain the stock market could be a very costly proposition. Let's listen in to this CNBC exclusive.
The headline unemployment rate has fallen from around 10% at the peak of the Great Recession to 4.1% today, but I still think that doesn't capture everyone who's out of the job market. And so my comment is, why are we raising rates when inflation is low and falling? And now more recently, we're seeing warning signs from the bond market. We've raised interest rates. The front end of the curve has gone up, but the long end of the curve has stayed anchored. That flattening is also sending a concerning signal. So for all of these reasons, I just didn't see the reason why we should raise rates right now. If we raise interest rates, not because of the job market, not because of inflation, but we simply raise interest rates to try to constrain the stock market, that can be very costly. From my perspective, we need to try to segment what's a stock market correction, and that's investors' problems, versus something that's going to lead to financial instability like 2008. I think we need to work very hard to protect against an 08 type scenario, but if markets correct, it's not the Fed's job to protect investors from losses.
Well, European markets in yesterday's trading session, they closed mostly lower. Well, the FTSE was a relative outperformer because that managed to eke out some gains at least. But if you're saying that the frontliners were under pressure, take a look at the emerging markets. The Brazilian index did see some selling. It was down close to around 0.5%. And the Russian index as well ended with a cut of more than 1% in yesterday's trading session. So clearly, yesterday, in fact, we saw more red than green coming in from the European markets as well as the emerging markets.
Okay, well, let's tell you about other asset classes. The dollar remains firm on expectations of a US tax overhaul, while a sharp rise in German bond yields takes the euro higher.
Well, and in the world of commodities and oil prices, they inch marginally higher as markets focused on the 40s pipeline shutdown in North Sea, as well as the OPEC-led production curbs. That's why we're seeing Brent crude prices well holding closer towards the $64 per barrel.
From precious metals, we have gold prices, which are little changed from overnight levels as the dollar holds steady on the tax bill hopes in the US.
Well, meanwhile, the Bitcoin took a dive, losing close to around $1,000 in the span of an hour. CME and CBOE Bitcoin futures also settled lower. However, as per the results of CNBC All-American Survey, it seems that if you are young or rich, you are likely to buy into the Bitcoin boom. CNBC's Steve Leisman has more on the same.
If it seems like the whole nation has gone Bitcoin crazy, well, it's because they sort of have. Our CNBC All-America poll of 800 Americans around the country finds 66% of the public has heard something about Bitcoin. That's up almost 20 points when we first asked the question in 2014. When we asked, have you heard a lot about it? Just 22%. But again, that's higher than 2014 when just 13% had heard a lot about it. What do they think about it? Well, just 6% say it's now an alternative to the U.S. dollar. 31% say it never will be, but 38% say, hey, one day it could be or will be an alternative to the U.S. dollar. But there are big differences in the public, sort of a digital divide when it comes to the cryptocurrency. Those who are younger are much more likely to be positive on the outlook for Bitcoin and its uses, while older folks, age 65 and older, just 20% are. Democrats more so than Republicans, and wealthy folks much more so than those in the lower income. Just 34% say it has a future for the Bitcoin currency. So if it seems like the nation is a little crazy on Bitcoin, well, it's because they are, but there still seems to be a way to go to have the kind of standing to be a real currency. Steve Leisman, CNBC Business News.
Okay, so maximum enthusiasm amongst the youth. But moving on, time for a quick break now. Up next, all the cues and news you need to work with for trade this morning. On the other side, stay tuned. Well, back home on Dalal Street yesterday, it was a good day of trade with the Sensex and the Nifty ending at record closing highs, and the real story stood in the mid-cap index, where the rally continued, and in fact the index ended at a record level for the second consecutive trading session. Naveen joins in to tell us what he's tracking this morning in terms of cues for trade. Naveen, hi, over to you.
So yesterday's trading session, remember, was fairly positive, but it was a sector-specific run. Mid-caps, as you pointed out, auto sector as well as the agri sector, they were up and running in trade. In fact, the institutional activity also, that was fairly decent. The DIIs, they bought close to 350 crore in the cash market. Meanwhile, the FIIs in the cash market, they sold close to 400 crore. But on the other hand, they hedged it by buying in the futures market. So in the futures, FIIs buying was close to 700 crore. So that was fairly hedged. On the other hand, global cues today morning morning seems to be more or less lackluster. The European indices last night, they ended with a cut of more than 0.5%. Dow also ended by more than 0.2%. On the other hand, SGX Nifty is in fact indicating a cut of close to 0.4%. So we would indicate a red on our bourses also. On the other hand, futures premium, that has more than halved to 7 points versus 15 points in the last trading session. Also, PCR ratio, remember, that has extended to 1.45 versus 1.31. So that indicates some bit of a vulnerability to the markets. Talking about the levels, if we see a downtick, remember the support will be seen at around 10,350. Why? Because the 10,400 put, that has added close to 20 lakh shares with a premium of 43 rupees. So keep an eye around the 10,350 levels. That will be the immediate support level for the Nifty. Back to you.
Okay, all right, Naveen, but what about some stocks that we're looking at in today's trade?
Well, Nigel, there are quite a few stocks. I'll begin with the big boy HDFC. Remember, they have approved the subscription to securities by HDFC Bank, and this is a whopping 8,500 crore. On the other hand, JP Associates, SBI, the bank has in fact invoked the pledge of 10 crore shares of JP Infra. On the other hand, Tata Steel, a stock that you closely track, that has approved the extension of the Kalinganagar capacity expansion from 5 million tons to 8 million tons per annum. On the other hand, Welspun Enterprises also, remember the company had earlier announced their foray into the NBFC space. Now the company has notified to the exchanges that they will be concentrating on their infrastructure business and would be no more getting into the NBFC space. DHFL, some fundraising over here. The company board has approved issue of NCDs worth 300 crore, wherein there is a green shoe option of 75 crores. Bharat Fin and IndusInd Bank, remember the merger was announced earlier, but now CCI has gone ahead and given an approval to the merger. Shoppers Stop also some rejig at the top level. So CEO Mr. Rajiv Suri will be taking over with effect from January 9th. Meanwhile, the earlier CEO Sanjay Chakravarti has resigned from the board. On the Indorama Ventures, remember that stock was up more than 18% in yesterday's trade. So post-market hours, the company has notified to the exchanges that there is an amalgamation of 4 of their JV companies along with IVL Dhanseri Petro, which will be the surviving entity for the company. Back to you.
Okay, all right, Naveen, thanks very much for that. Time for a break now, but up next, 2 major companies, Tata Steel and HDFC, are raising funds to expand operations. Details on both these companies and their plans on the other side.
Well, India's top auditor has questioned the government's fiscal math for financial year ending 2016. Now, in a report submitted to the Parliament, the CAG raised issues of transparency and variations in figures in the budget document itself. Now, the CAG has also pulled up the government for deferring the fiscal targets without corresponding amendments to the FRBM Act. The report says, and I quote, "In Budget 2016-17, the target date of elimination of effective revenue deficit was deferred from March 2018 to March 2019 without corresponding amendment in the Act. Further, in Budget 2017-18, the target date of effective revenue deficit was deferred beyond FY 2019-20 and that of fiscal deficit to FY 2018-19 by the government without amending the Act." End quote.
Okay, well, the CAG report goes on to say the deferment, that is, quote, deferment of fiscal targets needs to be carried out through appropriate amendment in the Act, end quote. That's not all. The CAG report went on to raise questions over what it calls understatement of fiscal deficit. The report says, and I quote again, a sum of 20,911 crore rupees collected under levies and cess forming part of tax or non-tax revenue was not transferred to earmarked funds. This led to understatement of revenue of fiscal deficit by an equal amount during FY 2015 and 16.
Well, the report also pointed out what it called issues of transparency. The report said, and I quote, "Refund of 1,29,482 crore rupees were made from gross direct tax collection in FY 16, but no corresponding disclosure was available in the government accounts." End of quote.
The CAG also called for some corrective action. I quote again from the report, an appropriate mechanism needs to be put in place by the government to avoid instances of inconsistencies in estimation and correct reporting of components of expenditure having a bearing on deficit indicators. End of quote.
Okay, all right, then let's get stock specific then. Everyone wants to know what Tata Steel is going to buy. How are they going to grow inorganically? Well, late last evening, they in fact released a disclosure on the exchanges. Now, Tata Steel plans to pump in around 23,000 crore rupees into its Kalinganagar plant. Remember, the Kalinganagar plant has a capacity of around 3 million tons. They set that up at around 25,000 crore rupees. Now, in fact, they're going ahead with the further expansion. Kritika joins in with all those details. Well, Kritika, this is the biggest domestic plant expansion undertaken by Tata Steel in what? In the last 4 years?
Oh, absolutely. This is easily the largest domestic expansion that the company has undertaken in the last 4 years. But let me first put this into context. Tata Steel had completed the phase 1 of Kalinganagar, but it was stuck with completing phase 1 as well as consolidating its Europe operations. The street was waiting for when the next big bet in terms of domestic expansion will happen. And now finally they have gone ahead and announced that they will be investing 23,500 crore rupees into the expansion. Now, remember, earlier they were looking at expanding their Kalinganagar plant to 6 MTPA, that is 6 million tons per annum. Now they have decided that they will increase by 5 MTPA. So now the capacity expansion will be 8 MTPA to begin with. In terms of how the investment will phase out, this will start within this year itself. So a bulk of the investment will come in within this year, and over a period of about 4 to 5 years, as the phase 2 progresses, they will be expanding that. Now, very important point over here, they will be funding a portion of this, that is about 12,800 crore rupees via a rights issue. This is the largest fundraising that the company has done in recent times. They had done a $200 million rights issue about 3 years ago. But again, the focus has been on Europe, has been on cleaning the balance sheet. So this is the big domestic expansion, brownfield expansion that they need to be able to set their footprint even further and stronger in India. And after this, we definitely will see some clarity on what happens as far as inorganic expansion is concerned.
Okay, well, big news coming in for Tata Steel, but big news coming in for HDFC as well. The board of HDFC has approved raising capital up to 13,000 crore rupees last evening. The funds will be used to explore opportunities in the health insurance space with HDFC Ergo. Ritu Singh is here with all the details.
The board of HDFC Limited has approved raising up to 13,000 crore rupees via an issue of equity shares or other permissible securities. The primary reasons for raising this huge amount of capital is, number one, to participate in the preferential allotment of HDFC Bank, where currently HDFC Limited holds, which is the parent company, holds about 21% stake, and that is a stake that they want to maintain and not dilute. So therefore, they will participate in the preferential allotment of HDFC Bank Limited to the extent of 8,500 crore rupees. The exact quantum of investment that they make in the bank will be determined by a panel that they've constituted with some directors. The second reason for raising this capital is to explore opportunities in the health insurance space along with their partner Ergo. They are also looking at opportunities in the acquisition and resolution of stressed assets, specifically in the real estate sector. The other reason is to set up funds for investing in the real estate space with a focus on affordable housing. They're also going to use this capital in the growth of some of the subsidiaries, namely HDFC Ergo, HDFC Education and Development Services, as well as HDFC Credila Financial Services. And lastly, they also mentioned in the press release that there could be some opportunities that arise, whether it is in the organic or inorganic segment in the affordable housing space, and therefore they need this capital, as a buffer that they will be looking to raise in one or more tranches soon.
Okay, thanks so much for that, Ritu. Well, time to slip into a short break. Up next, Ruchi Soya is the first company from RBI's second list to be sent to the NCLT. We'll get you more details on the other side of the short break.
Well, the board of the market regulator, SEBI, will get into a huddle on the 28th of December. Sources tell Network 18 that 17 issues will be on the agenda during this meeting, and the focus will be on the guidelines regarding the disclosure of default by listed companies. Remember, in October, the market regulator had shelved the plan to roll out those norms. Sources tell us that now SEBI is planning to water down that initial proposal, and a clear and relaxed set of norms for disclosure of default is probably something we could expect.
All right then, meanwhile, edible oil maker Ruchi Soya becomes the first company to be sent to the bankruptcy court from RBI's second defaulters list. Remember, RBI has directed banks to send unresolved cases like Ruchi Soya to the NCLT before December 31st. Ritu Singh is back with us. She joins in with more on this development. Ritu, the company was taken to court by two lenders that were not part of the Joint Lenders Forum.
Perhaps that's why it becomes the first company to be sent to the NCLT. Banks, being very active. But these two banks, remember, are MNCs that are not part of the consortium. So yes, Ruchi Soya is now, declared corporate insolvent by two lenders, that is DBS Bank and Standard Chartered Bank, to which it owes 33 crores and 150 crores respectively. Overall, Ruchi Soya has a debt of about 5,300 crore rupees. And now the entire consortium of lenders, that is 17 lenders headed by State Bank of India, will also have to fall in line with this process, and therefore make 50% upfront provisions, that is over 2,600 crore rupees as they send this company into NCLT. Remember, this is part of RBI's second defaulter list, and banks did anyway have a deadline of December 31st to send the company to NCLT. But now that this petition by the two banks outside the consortium is accepted, Ruchi Soya does become the first company to be admitted under the IBC code from that second defaulter list.
All right, thanks Ritu for that. Time for a break now, but up next, the first story from our special series Rewind 2017. We'll bring you a report on how India managed a 30-place jump on the World Bank's Ease of Doing Business ranking. That story coming up next. Well, talking about the healthcare space now, after a scathing report from the NPPA highlighting huge margin markups in corporate hospital Fortis's inpatient bills, there has been a growing call for regulating private hospitals. But is it feasible? On the sidelines for book launch, Wockhardt Hospital's chairman Habil Khurakiwala said the government is abdicating its responsibility by just expecting to regulate the private sector.
Here a government is abdicating their responsibility fundamentally of not taking care of their citizens and providing proper healthcare facility. And then you expect the private sector and bring about a regulation for everything. It's a counterproductive in terms of who will then create healthcare facility in India to fill up the vacuum which is there. This whole mindset of control, and if there is some problem, bring some kind of control, that action-reaction is not the way a country can grow and can develop. You need to look much more fundamentally to find a solution to that. Whatever is the government's ten prices there, we will stick to it. But purely from the science, technology and point of view, what will all this lead to will be that India will not be receiving new technology in all these areas. To that extent, it is a retrograde step of the government to look at some of these areas from a very short-term point of view and take these kind of restrictive action.
Well, as 2017 winds down, one of the biggest achievements of the Indian government has been engineering India's sharp rise in World Bank's Ease of Doing Business rankings. CNBC-TV18's Ritu Boyan as well as Arif Sherwani find out whether India has the wherewithal to repeat or better the record 30-rank jump in 2018.
No one thought that we can make a breakthrough jump of 30 in 1 year in these rankings.
The World Bank's Ease of Doing Business rankings are a testament to India's reforms agenda. And with a 30-rank jump in the rankings, India has clearly been one of the stars of the World Bank's index. More so because it managed a significant improvement in 6 of the 10 parameters that determine global rankings.
और ये कोई जनरलाइज्ड रैंकिंग नहीं होती कि आपने क्या क्या कार्रवाई की अपने देश में बिजनेस एनवायरनमेंट को इंप्रूव करने की। ये कुछ स्पेसिफिक क्षेत्रों में होती है और उसकी बहुत ही कठिन मापदंड लेते हैं वो।
India's 2017 ranking at 100 has been its best placing since the index came to be in 2003. But the big question now is whether India can better its ranking or even just hang on to its current place.
It has done very well for a cricket-loving nation to hit a century. Is fantastic. And the question is now that India has gone up, how it can continue to improve, knowing that the higher you go, the more difficult the climb to the top.
One big achievement has been the sharp improvement when it comes to protecting the interests of minority investors. India's systems and protocols make it the 4th best country in this category, an improvement of 9 places over last year. But this pales when you consider that India's ranking in the getting credit parameter has improved to 29 from 44, while its ranking when it comes to resolving insolvency has improved 33 places to rank 103.
So, but the improvement in ranking this year is because we have a code, we have provided for certain provisions there, which the World Bank considers very positive.
India's performance has been even better in the category that looks at paying taxes, where it has climbed 53 positions to 119. The other areas of improvement include India's policies, systems and protocols in enforcing contracts and in dealing with construction permits.
That the number of procedures have come down to 30, the cost has come down and so on, and the distance to frontier has also improved. But the improvement in ranking is not exactly what we had thought.
So where did India falter? India's overall rankings could have been much better were it not for 4 parameters. That's starting a business, getting electricity, trading across borders and registering property.
According to World Bank, as countries move up the rankings, it gets difficult to improve upon them. But India has a strategy in place which includes 90 new reforms which will be captured in next year's Doing Business survey. Not only that, the 2018 survey will also better capture the user feedback of existing and ongoing reforms. But however hard one might try, getting to the top 50 position before the end of the Modi government's tenure will be rather difficult. In New Delhi, Rituparna Bhuya.
All right, time for a break now, but up next, a check on all the cues to watch out for from the F&O space. Let's get talking about what's happening in the commodity and the currency space. We have Manisha Gupta joining in to tell us the cues there. Manisha, morning.
Hi, and thank you so much for that. Well, the crude oil prices have seen some strength come back on supply concerns. It has been the North Sea pipeline shut anyways. The OPEC supply cuts compliance also seems to be around 100%, and that has been supportive. There has been a missile fired at Riyadh from Yemen, and while, of course, Saudi Arabia has issued statements on that, the geopolitics markets now understand would be a part of premium that would continue to be in many of these asset classes, even as we get into 2018. And add to that the fact that the markets are anticipating that you will be looking at a 5th straight week of decline in U.S. crude inventories, and that, of course, is supportive. As we have been saying, the only reason you haven't seen more gains in the crude oil prices is because the shale output continues to increase, and markets are factoring in a record production in the month of Jan itself in 2018, and that is capping the prices too much. Apart from that, the metal space, of course, all the rallies that we have seen in the recent days are used for unwinding. China, in a latest report, has suggested that they have found 5 steel and aluminum producers which haven't really been cutting output as they were advised to do. So those inspections are coming in as well, and that is something that the markets would start weaving in sense of metal prices.
Oh, interesting one, Manisha. If they're not doing what they've been told to do, that's going to be quite interesting if some of those steel and aluminum producers, you know, with the entire premise of all these aluminum stocks as well as steel stocks moving up was that China's going to cut down production. In fact, some of them are not adhering to it. That's not very good news, actually, for the entire global steel space and entire global steel pricing. But yesterday, we were tracking the premium on the Nifty. Remember, a couple of trading sessions ago, it was at around 30 rupees. In fact, now it's come down to sub that 10 rupees odd mark. Mangalam joins in to run us through all the cues that are coming in from the derivatives market. Mangalam, good morning.
Good morning, Nigel. Yes, you're right. The premium did come off, but just take a look at a couple of things that are going for us over the last 2 trading sessions. Post the Gujarat election verdict, last 4 sessions itself, the Nifty, which has gained about 400 points, and we're virtually at the record high levels. Volatility has come down. In the last 2 sessions, ahead of going into Gujarat election, the India VIX was close to around that 15 mark, has collapsed about 18.5%, 19% from there, currently trading at 12.18. Another thing, with the VIX coming down, the put-call ratio has also moved higher. So that means a lot of puts are being written, a lot of calls are being covered. So the put-call ratio, which was closer to that 1.3 mark, has now gone higher to 1.45. But remember, the FIIs are adding some shorts. That perhaps explains the kind of premium dip that we've seen in yesterday's trading session from the higher levels. So the FIIs, while they net bought about 220 crores in index futures, remember, yesterday they added close to around 7,500 shorts as well, and they're still only 55% long in the index futures itself. The premium, yes, did decline, and that was on the December futures. If you take a look at the January futures, that was very interesting. Nifty Jan futures yesterday added close to 11.1 lakh shares in open interest, and that was something that I really kept an eye out on, and that was really interesting. As far as index options are concerned, positive cues coming in from there. The FIIs added close to 5,000 longs, covered close to 4,800 shorts, and even in index puts, more short puts were added than long puts. A lot of the strikes were in focus, so keep an eye out on that.
Okay, all right, Mangalam, thanks very much for that. And with that note, we're going to wrap up our breakfast. We leave you with the picks of our bullseye contestants for today.
My first call is a buy call on Jet Airways. The closing price of the stock was 720 rupees. It could be bought for a target of 740, and a stop loss of 700 is strictly recommended on the stock. My second call would be a buy call on Tata Motors. The closing price of the stock was 420. It could be bought for an intraday target of 432, and a stop loss of 408 should be strictly kept on the stock. My third call would be again a buy call on DLF. The stock closed at 235 rupees yesterday. It could be bought for a target of 240, and a stop loss of 230 should be strictly maintained on the stock. My final call would be a buy call on Walchand Nagar Industries. The closing price of the stock was 229. It could be bought for an intraday target of 240, and a stop loss of 222 should be strictly kept on the stock.
I have a buy call on KSCL, stop loss 540 and target 576.50. Next one is a buy call on Radico. Stop loss has been placed at 272.80 and target at 291.70. The third one is also on the long side, that is Ashok Leyland. Stop loss 115 and target on the upside will be 123.30. Whereas the last one is on the short side, that is Havells Futures. Stop loss 568 and target on the downside 531.50.
DHFL buy with a stop of 583 for targets of 625. L&T Finance Housing buy with a stop of 165 for targets of 185. Tata Global buy with a stop of 295 for targets of 325. And Tata Motor DVR buy with a stop of 225 for targets of 245.